Up here where we left off yesterday, and we're going to figure out from we figured out how to calculate Social Security benefits yesterday. Some of those are taxable, so you have to pay income tax on Social Security benefits that you're receiving, and so this is the form to figure out how much of your Social Security income is taxable or not. Okay, so in our first form it says enter the total amount from box 5 of all your forms, SSA 1099 and RRB 1099. So the government will send you these forms, the 1099s, and it's kind of the same thing as being an independent contractor. Taxes have not been taken out of your Social Security benefits. So he made $19,612, so that's what goes right here, 19612. Okay, so that would be on line 1, like on the homework packet. Okay, then line 2 says enter 1/2 of line 1. So I'm going to need to take half of that. Is that divided? I can't see. Divided by 2. And I have 9806. So that's what goes on line 2. Half of your income goes on line 2. Okay, and then it says enter the total amounts from form 1040. So this is while you're doing your taxes. So line 1040 is 7, 8A, 9A, 10 through 14, 15B, 16B, 17 through 19, and 21. These are all those income lines on the first page where we were filling out to make all of our adjusted gross income. So, bank interest, dividends, pension, IRA, income, all that. So you take all of that and add it together. So here on his form 1040, the total is 80,433. So I'm going to write that there, 80,433. And I kind of missed. So, too big.
Oh, thank God.
It's just... Now this form doesn't get filed. It's just for calculating. Okay, then the next line says enter the amount, if any, from 1040 line 8B. 8B on his form 1040 shows 519, so that's what goes right there. And then it says add lines 2, 3, and 4. So I'm going to add these 3 lines. So I have 9806 plus 80,433 plus 519. And I have 90,758. So 90758. Then the next line down says enter the total of the amounts from 1040 lines 23 through 32 plus any write-in adjustments you entered on the dotted line next to 36. So lines 23 through 32 is 1239. Line 36 does not have an amount, so that was blank. So I just put the 1239 in here on line 6. Line 7, it says, is the amount on line 6 less than the amount on line 5? Well, line 5 is 90,000. Line 6 is 1,200. So, yeah, line 6 is less than 5. So we're going to say yes, and we're going to subtract line 6 from line 5. So I have my 90,758. I have to subtract 1239. So I have 89,519. Okay, so as you can see, as you go through, you read each of these and it tells you exactly what to do. The problem that I give you will have the information just like this. The total of is this. So you would have already filled out your 1040 form, and then you're doing this part, and then you go back to the 1040. So we're just go through and read each of these, and it tells you exactly what to do. Okay, so number 8, if you are married filing jointly, enter 32,000. Single, head of household, qualifying widower, married filing separately, etc. Well, married filing jointly. So he enters 32,000. Okay. Then you go to 9. Is the amount on line 8 less than the amount on line 7? Yes. Since it's less, I subtract. So I'm going to take that 89,519 and take 32,000 away from it. and I have 57,519. And if it hadn't been, then you just read the directions there. If no, stop, none of your Social Security benefits are taxable. It tells you exactly what to do. Okay, so number 10, enter 12,000 if married filing jointly, or 9,000 if single head of household, qualifying widower are filing separately. Okay, well, we're married filing jointly, so we're going to enter the 12,000. Line 11 says subtract line 10 from line 9. So I subtract another 12,000 from this. And I have 45,519. Okay. Line 12, enter the smaller of line 9 or 10. Line 9 is 57. Line 10 is 12,000. Obviously, line 10 is smaller. So I'm entering line 10, 12,000. 13 says enter 1/2 of line 12. Half of 12,000 is 6,000. 14 says enter the smaller of line 2 or line 3. Line 2 is 9,800. Line 3 is 6,000. Or sorry, line 13 is 6,000. So I'm entering the smaller, which is the 6,000. 15 says multiply line 11 by 0.85. Line 11 is this 45,519. I multiply that by 0.85, and I get 38691.15. So I'm just going to put in 38691 because you do round on taxes a lot of times. And so on these you can just round and not have to worry about the change. It'll be easier. Okay, add lines 14 and 15. 14 is 6,000. So I'm going to add the 6,000 to that. We're just going to keep ignoring the 15 cents. So it's 44691. Okay, multiply line 1 by 85%. Line 1 is way up here than 19. So 19612 times 0.85, 16670. And then 18 is taxable Social Security benefits. So you enter the smaller of line 16 or 17. 17 is smaller than 16. That is your taxable Social Security benefit, and that gets entered on your line 10 on your 1040. So that's how we fill that out, and then this would go back to your 1040, and it would be line 20B. So when you collect Social Security, this is the formula. I mean, it'll look a little different, obviously, by then, because they change them a little bit here and there, but the gist remains the same. So when you're collecting Social Security benefits, you do have to fill out this worksheet to find out how much of your Social Security is taxable. And if you don't have additional income, it could end up being 0. But Rob had this $80,000 income thing in there. Okay, so when you apply to receive Social Security, you can also apply to receive Medicare. And right, so for Medicare, Part A is hospital insurance. Okay, so this is what covers you if you have to be checked into a hospital. So if you're an inpatient. Okay. Part B is medical insurance. Okay, and that covers doctor's visits and things that are associated with the doctors, like lab testing. You know, if you have to go get an ultrasound or something, that would be there also. Part C is called Medicare Advantage. Okay. and that covers, is only available in some areas. And if I'm not mistaken, it's kind of like a supplemental. Not everybody gets it. I think that's state, basically. And then Part D is prescription coverage. What? Oh, practice. So prescription coverage is, for your medication. There is a monthly premium for Part B. Has a monthly premium only. Okay, in 2009 or 2008, it was $96.40, and there's a standard that everybody has to pay, and then plus extra over a certain income. And I'm going to look up the current ones. So in 2015, the standard premium is $104.90, and that's monthly. Okay. So Ryan was retired, and he qualified to receive Medicare, and he pays the standard monthly premium. So how much did he pay for the year? Well, he's $104.90 per month times 12 months. So he paid $1,258.80 for the year. Now we're on to section 3, which is on pensions. We love pensions. Remember I said about a pension? Pension is guaranteed money till you die. Okay, a pension is a deferred compensation plan, and deferred compensation is money that is given or received at a later date. For services provided now. Basically, they're saying you work now, and we're going to pay for it later. You do get paid for what you're doing now, but they kind of it's like they're holding some back to pay you when you retire, if that makes sense. The pension is a deferred compensation plan. Okay, so the pension is income given to an employee after retirement. At the discretion of the employer. So a pension is still income. It's retirement income, but it's actual income that you're still earning, basically. Okay, there is no law that says an employer has to provide a pension plan. They do not have to. That is voluntarily. It is usually tax deferred, which means you will pay taxes on it later. And then the contributions from the employer makes, they get tax deductions for it. Okay, so there are two kinds of pension plans. We have a defined benefit plan and the defined contribution plan. Okay, the defined benefit plan, let me pause this so I can just write. All right, so the pension benefits are calculated by a formula which usually includes an average salary, number of years employed, and a multiplier. And the multiplier is a percentage. Okay. In order to receive benefits under every pension plan, you have to be vested. And vesting is when you have earned the right and it's usually after so many years. Okay, mine, I have to work here 8 years to be vested to get the pension. That's what that means. So if you only work there for 1 year and then you leave, you don't continue to get the pension benefits. You have to earn it. And then they have graded vesting. And graded vesting is not an all or nothing. There's a percentage of earned pension. Based on a scale. So for example, if you worked there for 1 or 2 years, you might get 5% of the pension. And then if you worked there for 3 to 5 years, you might earn 10% or something like that. Those are kind of nice because then if you end up having to move on, you did still earn some kind of pension as opposed to working at a company for 3 or 4 years and not getting vested because they have an 8-year vesting period. And then you get nothing as far as retirement goes. Okay, so there's different kinds of pension benefits. You can get a single life annuity, and it's a fixed monthly amount. Until death. Okay, so that's when the benefits stop. The good thing about this is you're going to get a check every month until you die, from the time you retire till you die. The bad thing about this is if you die, your spouse doesn't continue to receive benefits. Like your spouse and kids, or there's no more money after that. Okay, so we talked about the single annuity, life annuity, which you get a larger payment, but it's only for you, and you get it from the day you retire till the day you die. Or you might be able to get a qualified joint and survivor annuity, which means that you get a smaller monthly payment, but if you die, your spouse still gets the payment until they die. So it's less each month, but if you go, they're still provided for. They still get a pension check. Whereas with the other one, if you go, then they don't have any money coming in, unless they had their own pension or their own retirement of some sort. Or there's a lump sum payment option from some pensions where they take all the money that they figure out that they owe you for your pension and they give it to you as a single payment. And while this is nice because you'll get a big old giant chunk of money in a check, when it runs out, it runs out. You don't get any more other than this one single one-time payment. So it's a gamble. If you have other retirement accounts, it might be worth it. Then there's the formulas. There's 3 major formulas used to calculate a pension. There's the flat benefit formula, which they take the number of years that you worked and they multiply it by some amount of dollars. So let's say they decide their amount of dollars is $50. And you work there for 20 years, they'll say 20 times 50 is $1,000. That's how much you get every month. Or they have the career average formula where they take all the years that you worked, they take all of your salaries from every single year, they find the average salary, and then they multiply it by some percentage. And that can be 50 to anywhere between 50 and 100% or whatever. And then they have the final average formula where they take the average earnings from the last several years. Bless you. Usually 3 to 5 years. And they take those final averages and then they use that and the number of years in service and some multiplier to figure out how much your pension is. I would say that probably the final average formula is the most common. I might be wrong, but I think it's the most common. Pensions are protected by, most pensions, not all, are protected by the Pension Benefit Guaranty Corporation, which is a federal pension insurance program. Okay, pension money gets invested, and it gets invested at the discretion of the employer. And what happens is all of the money that you get that's going towards your pension gets put in an account together. So, for example, here, everybody that works here, all of their money is pooled into some big, giant pool of invested money. And the reason they do that is to earn money on the money that they're putting in so that the pension fund gets larger, so they have more money to pull from. Well, the Pension Benefit Guaranty Corporation protects you from, you still get your pension regardless of what happens to the employer's money. And that was created by the Employee Retirement Income Security Act in 1974, which is ERISA, and it protects the pensions of the retirees to make sure you get your benefits. And then it was amended in 2006 by the Pension Protection Act, which actually created stronger legislation to prevent companies from denying pensions that were earned or from, not paying them. Some pensions are fixed. So if your pension is $2,000, you're going to get $2,000 every month for the rest of your life, period. And then some offer cost of living adjustments, which is COLA for short. And those are small increases in your monthly benefit based on the Consumer Price Index, which measures inflation. Basically, it measures the difference in the cost of living. And I pulled up New York City website, real estate. In 1910, rent was $40 a month. 40. In 1950, rent was $60 a month on average. In 1970, $335 a month. And in the 2010s, rent is up to $3,500 a month. This is cost of living change. This is due to inflation. If you retired in, let's say, 1990, rent is $3,200 a month on average in New York. And it's now 2015 where rent is on average $3,500 a month. That's a $300 a month increase in your cost of living just for rent. Everything else has also gone up. So if you have a fixed pension where it's the same amount of money every month, and you have those cost of living increases, you may not be able to now afford where you were. Well, yeah. But the cost of living increases on the pension are adjusted to help meet those changes in inflation, because $2,000 20 years ago does not go as far, $2,000 today does not go as far as $2,000 20 years ago, right? You could buy more with $2,000 20 years ago than you can today. And if somebody retires at 65 and lives to be 85, they'll experience that change. 20 years ago, not to age myself or anything, but gas was less than $1 a gallon. Rent was, I paid like $400 a month for my 2-bedroom apartment. Couldn't get a 200-bedroom apartment for $400 a month now, so that the cost of living adjustment, if you have a pension with COLA, that's a good thing, because it'll change your monthly benefit to meet the inflation rate. So whatever the inflation rate is, whatever that percent is, the COLA should match it or be really close to it. Any questions on that page? Roberto worked for Surgical Tools for 20 years. He gets a pension benefit package with a flat benefit formula. So you get $40 for each year of service to calculate the monthly pension. So he worked 20 years, and you get $40 per each 20. So he's going to get $800 a month for his pension. Here, after 1 year of retirement, Roberto's employer offered a 2.21% cost of living adjustment. And then this year, they're offering a 2.35% COLA. So what we do is we take that $800 and we multiply it by 0.0221 to find out the first adjustment. So 800 times 0.0221 gives me $1,768. So that brought him up to $817.68 per month. And then they're now offering a 2.35%. So we multiply that by the new adjustment. So 0.0235, and it's now $19.22 that is raised. So I take the $817.68 and I add the $19.22. And his current benefit is $836.90. All right, Alex's employer offers an annual pension calculated by multiplying 1.5% of his career average salary times the number of years employed. He's kept his list of his salaries. These are all his annual salaries. He's got 1, 2, 3, 4, 5, 6, 7, 8 times 3, so he's got 24 years. So we're going to take 1.5% times 24 years times his average salary. Okay, so now I had to figure out his average salary. So to find the average, I'm not going to write it out because it's a lot, so I'm going to add all and then divide by 24. Okay, so I'm going to pause while I do that. Okay, so I've got the average salary. So I'm going to take 0.015, that's the 1.5%, times 24 times 7064629. And I get $24,532.66. That's yearly. So that's the annual pension. And then I divide that by 12. And I get $2,119.39 monthly. If you want to know how much of that salary it is, you take the 0.015 and multiply it by 24. And so you can see that it's 36% of his regular salary. Brian and Marina are married, and each is planning on retiring after 30 years of employment. She worked the entire 30 years for Santa Fe Corporation, and she's making $110,000 per year for the last 3 years. Brian is making the same salary for the last 3 years, but he's only been working there for 15 years. So he also works there about half the time. Prior to his current job, he worked at a competitor and had a final average salary of $60,000. Both employers offered a defined benefit plan that calculated the annual pension as the product of the final 3 years average salary, the number of years of service, and a 2% multiplier. So compare, that's not even a word. Okay, calculate and compare their annual pensions. So Marina is just going to have the one from Santa Fe. Okay, so she's got a 2% multiplier. She's worked there for 30 years, and for the last 3 years, she's making $110,000 per year. If you make the same amount every year, your average is that amount. You don't have to calculate that. You don't have to add it up 3 times and then divide by 3, right? So she gets $110,000 as her average. So if I multiply that together, you got $66,000 per year for Marina. Now Brian has 2 jobs. Both have a 2% multiplier, 15 years though at each. At Santa Fe, he's been making the same salary, so $110,000, same as Marina. But at His prior company, it was $60,000. So he's going to get $33,000 a year from Santa Fe and $18,000 a year from this other company. So he's going to get $51,000 a year. So here's Marina's, here's Brian's. Brian is less by $15,000. However, if you look at this, she's going to get $66,000 a year. He's going to get $51,000 a year. They're still going to be doing pretty good. Plus, they're both making $110,000 a year, so hopefully they socked some of that away on top of it. This is that graded vesting chart thing I was talking about. So if you're at 0 or 1 years, you don't get any pension. It's 0% of the pension. But if you're there for 2 years, you'll get 20% of the pension. 3 years get you 40, 4 years get you 60, 5 years get you 80, and then after 6 years you get 100%. So you still have the multiplier times the number of years in service. It's just that you only get a certain percent of it. So 5 years is when Anne decided to leave. So she's going to get 80% of the pension. So you calculate the pension and then you multiply it by 80%. Or you just throw the 80% in there.
I have to ask you about the pensions. What happens if the business closes?
It's protected under the
Government?
that insurance plan. The money for a pension, as I work here or as anybody works and their money is going into a pension, is put into an account. And it's a separate pension account. And that money is supposed to sit in that account and not be touched for anything other than pensions. The money is sitting into an account that is protected by that insurance company.
But by law, they have to give you the money. It's your money.
Right. Now, there have been companies and corporations that will go to jail. People have gone to jail because they have touched the pension fund. It is illegal to touch a pension fund for anything other than to pay pensions. So you, yeah, but that has actually happened where companies have taken the pension funds and used it for other things or whatever. That is illegal. Money for a pension goes into a pension fund and it can only be touched to pay pensions. It cannot be used for anything else. And that's federally mandated. That's a law. I didn't put her average her salary on here. Yeah, okay. We'll just throw it in here. Her average salary was meant to be $50,000. So I don't know why I didn't type that in, but it was meant to be $50,000, and she's going to get 80%. And they use a 2% multiplier, and she's worked there for 5 years. So she has 2% times her 5 years times her average salary, and since it's only been 5 years, we have times 80%. So this is the 80% right here. Okay, so you calculate it exactly the same, except you throw in this other percentage. If it was 6 years, we wouldn't have to, because she'd have 100%. Does that make sense? Okay. So 0.02 times her 5 years times her 50,000 times her 80%. So she's going to get 4,000 per year, or $333.33 per month. So this is nice. Let's say Anne was young and she was making $50,000 and she quit this job and she went and got another job that had a pension. She'll still get this one, the 80% of it, because the money went in there. She worked there for 5 years. So when she retires, she'll have to come back and contact this company and she'll get her money.